Financial Daddy and Investment Life bring you freedom of financial.
Hello everyone. Today I want to share how to build a solid investment portfolio so you can sleep well at night and feel at ease. Although I've mentioned before that if you're going to invest, you should invest in companies with strong technological moats, like Tesla. But in the long run, will they definitely be the winners? Because their innovation and market dominance will lead to continuous growth, but short-term volatility can be an issue. The stock market often sees corrections of 10% to 20%. And in these situations, growth stocks can easily drop by 30 to 40%. For example, during the bear market in 2022, the Nasdaq index once plunged by more than 30%. Many tech stocks, like Meta, were even cut in half at one point, putting huge psychological pressure on investors. Now, considering the current economic environment, under this kind of risk, it's even more important to be alert to how much the US economy relies on the top 10% of high-income earners. They contribute the majority of consumer spending, so if these people start tightening their spending, for example, cutting back on luxury purchases due to inflationary pressures or job uncertainty, the driving force of the whole economy will gradually weaken. Just imagine if demand for high-end consumption like luxury cars or overseas travel dropped. This would impact the automotive, tourism, and retail industries, dragging them down. As a result, GDP growth could slow, causing a mild recession, and the stock market could drop 10 to 20%. The recent Netflix earnings report is a good example. Although the company blamed its lower-than-expected profits on an unexpected expense of about $619 million to settle a tax dispute in Brazil. But the deeper reason is that the growth rate has only stayed at 15%. Subscriber growth of 7 million was slightly below expectation. It's not explosive growth, and on top of that, the valuation is high. With a P/E ratio of over 50 times, it's already fragile. If the economy slows down, investors will start selling off these expensive stocks and move their money to safer assets. Also, during these uncertain times, what should we do? Of course, one thing is to keep a close watch. Pay attention to the earnings reports of other big tech companies, like Amazon or Microsoft's next quarter results, and see if their cloud services and AI investments can keep up strong growth. Secondly, my advice is to diversify your investments. Never put 100% of your money into a single type of asset. This not only helps reduce volatility, but also provides protection in different scenarios. My personal investment portfolio is a good example. Right now, I have 50% allocated to TLT. TLT is an ETF that tracks US Treasury bonds with maturities of 20 years or more. Why do I do this? Because I expect the Federal Reserve to continue cutting interest rates, which will directly push up the price of TLT. To put it simply, the value of a Treasury bond ETF moves inversely with interest rates. When rates go up, bond prices go down. On the flip side, when interest rates fall, bond prices go up. It's like a leverage effect. Long-term bonds are the most sensitive when the Fed cuts rates to stimulate the economy. For example, TLT holds a large amount of 30-year Treasury bonds. If the interest rate drops from the current 4% to 3.5%, TLT could go up by another 1 to 2%. This is based on historical data, such as its performance during the 2020 pandemic. Recently, TLT's technical trend has also been very positive, already rebounding 15% from its low point. The most important thing, in a stock market crash, TLT can act as a shield. If there's a major recession and stocks drop 20 to 30%, TLT could rise by 20%. For example, during the 2008 financial crisis, long-term treasuries went up nearly 30%. In my own portfolio, if half is in TLT and TLT rises 20%, it can offsetting the potential losses of the other half of the assets, so the overall portfolio only drops slightly or might even go up a bit. Is this better than going all in on growth stock? This is actually more stable than putting everything into growth stocks, even if there's no recession. The Federal Reserve is basing its decisions on the latest labor market data. The unemployment rate has already edged up slightly, and it's expected there will be 2 more rate cuts. The yield on TLT should steadily rise by about 5%, which is a low-risk guaranteed return. That's way better than the current zero returns. For the remaining 50% allocation, my suggestion is this. Allocate 30% to the strongest tech growth stocks, like the top 10 AI companies, or companies like AeroVironment, AVAV. Why do this? Because a rate-cutting environment favors growth stocks. Lower interest rates cut borrowing costs, making it easier for these high capex companies to expand, invest in R&D, or grow market share. In the Fed's rate-cutting cycle in 2019, Nasdaq growth stocks averaged a 40% increase. Take TEM as an example. This AI medical company's stock price has already soared about 100% in 2025, hitting a new 52-week high, thanks to the application of AI in cancer diagnosis. Analysts predict an average target price of over $90, showing huge growth potential. IA is also a star in AI investments. Since its IPO, the stock price has surged over 2,600%, that's 26 times, and its revenue in 2025 is expected to reach $4.16 billion. The forward PS ratio is 101, based on government and corporate contracts, including projects with the U.S. Department of Defense. In the commercial sector, AVIV has performed well under strong defense demand, with its stock price near its 52-week high. The average price target is $356, with the highest at $430. Demand for its Switchblade drone system has surged amid geopolitical conflicts, and interest rate cuts will spur innovative investments during the rate hike cycle. If the economy achieves a soft landing, these stocks have huge upside potential. On the other hand, even before a recession, they can still outperform the broader market. With the moat provided by AI and defense, they can withstand market volatility. Of course, right now, their prices are already at high levels, so if you didn't get in at the bottom and are holding stock, I suggest buying in stages instead of going all in at once. Also, you should keep 10% in cash. This portion is for flexible use, like adding positions at market lows during panic to see short-term opportunities. Reserve the last 10% for buying new IPOs. The other 10% should be allocated to precious metals or crypto assets. For example, gold and Bitcoin. Gold is a classic safe haven asset, rising during times of geopolitical tension or inflation concerns. Bitcoin is more like digital gold, and in 2024, expectations of interest rate cuts have already pushed its price up by over 50%. But remember, these are just satellite assets and should only make up a small portion. Allocate only a small portion, especially if your risk tolerance isn't high. You should gradually increase your position to avoid being overly exposed to volatility. In summary, this portfolio lets you feel secure in the current stock market environment, while still giving you a chance to outperform the market. Of course, the returns won't be as explosive as putting 100% into growth stocks, but at least there's a potential upside of 10 to 20%, and the risk-adjusted returns are definitely worth it. To put it simply, if the bull market goes up by 30%, growth stocks rise by 30%. That means it actually contributes 9% to your portfolio. If 50% of your portfolio is in TLT and it goes up by 5%, that's a 2.5% contribution. The total return is about 35%. In a bear market, growth stocks drop by 30%, but TLT goes up by 20%. The net growth is about 1%. That's much better than the 30% drop if you were all in growth stocks. Investing is risk management. This portfolio is like a ship with a lifeboat. No matter how rough the seas, you can sail on. Hope this helps. Questions? Let's discuss.
Please subscribe and follow New York Daddy Investment.